Hi, value investors. Welcome to my channel. Warren Buffett has bought 104 million shares of Hewlett Packard in the last quarter, and well, we will try to find out what are the reasons of this purchase. We will explore a little bit more about the intangibles of this company, and we will try to find out if it makes sense the price that Warren Buffett has paid for this stock, which is something like $36 per share. So really, we know that the price to earnings ratio of this company is something between 6 and 7 times earnings per share, which means that the market is not so much optimistic about the growth prospects of this company, considering that the company is facing strong competition with other important competitors in all the markets in which the company has presence. Adding to the fact that a company like Hewlett Packard, which offers printing equipment and PCs to the market, have experienced a surge in its growth in sales in the year 2021 because of the COVID scenario. And right now we are getting out from this scenario, at least partially, so we could expect a deceleration in its growth prospects for the future, and combined with a scenario in which we are experiencing supply chain constraints really. So all these three factors could contribute to reduce the growth expectations of this company. So despite all these factors, Warren Buffett has bought the shares of this company anyway, so most likely we are overlooking something, and this is the kind of things that I want to discover in this video. So the first thing that I will do is to show you what is the breakdown in revenues in order to understand the business model of the company. Then I will show to you what are the metrics of this company. I mean, Hewlett Packard Incorporated. And we will compare with the metrics of Hewlett Packard Enterprises. You know that in the year 2015, there has been a separation between these two companies, and we will understand what are the main difference between these two companies, and we will try to explain why Warren Buffett has chosen Hewlett Packard Inc. over Hewlett Packard Enterprises. Then I will calculate the intrinsic value of this company, and we will find out what has been the margin of safety of Warren Buffett paying $36 per share. And the last part, I will explain some important qualitative aspects about the company, the growth prospects of the company, and particularly I will focus in the quality of the management, that probably it could be one of the most important factors that could have attracted Warren Buffett to invest in this company. So I will start right now. Now, this is the breakdown in revenues here. You can notice that there are two important business units here. The personal system, which includes the notebooks, the desktops, the workstations, and so forth, and the printing business. You can notice that the personal system represents of 68% of total revenues here, whereas in the case of the printing business, it represents 32% here. Now, in terms of the earnings from operations, you can notice from the total earnings from operations, the printing business represents more than 50% here, whereas in the case of the personal system, it represents 46%. Well, you can notice that in the case of the printing business, it is way more profitable, and this is because it has better margins here. You can notice that if you divide the earnings from operations by the revenues, here you can notice that the margins here are 18% in the year 2021, 14% in the year 2020, whereas in the case of the personal system, the margins is something between 4% and 7% in the last 3 years here. So really, see, this is the most important business here, the printing business. But something that is important to mention is that in the last 2 or 3 years, the company has established a new model for the printing business. It has been established a transition toward the subscription model, which means that all the customers that are adopting this new model, they are only paying a fee each period, and they are receiving upgraded printing machines and all the accessories related to the printing. This is something really interesting because it is really well convenient for the customers, because the customers do not have to think in buying new printing machines and all the accessories related to the printing machines really. And adding to the fact that it's well convenient for the company as well, because it enables Hewlett Packard to offer more added value services to the customers, and in that way increase the fee charged to the customers really. Another important positive factor related to this subscription model is the fact that it enables the company to reinforce its recurrent revenues and its recurrent free cash flow. there are only 20 and 30% of the total clients of Hewlett Packard that has adopted this new subscription model. But it is expected that this percentage will increase in the next years, and that, of course, will be something good for the company here. Well, these are the metrics of Hewlett Packard Inc. I just collect all this data directly from the financial statements of the company here. And something important to notice is that in the year 2015, there has been a separation between the Hewlett Packard Inc. and Hewlett Packard Enterprises. I will show to you the metrics of Hewlett Packard Enterprises as well in order to make a proper comparison with Hewlett Packard Inc., which is the company that was chosen by Warren Buffett here. So really, but here, of course, you need to remember that in the previous years of 2016, in all these years here from the year 2012 to the year 2015, really all these metrics are the consolidated numbers of these two companies. So really, I mean, all these numbers comes from the balance sheet, income statement, and cash flow statement consolidated in these two companies. Since the year 2016 to the year 2021, the Hewlett Packard Inc. was already separated, so we could focus in this period, in this sample, in order to find out what are the factors that truly attracted a super investor like Warren Buffett. Now, the first thing that I will show to you is the growth in sales. Really, you should notice that this is a company that do not characterize for delivering high growth in sales, really, because well, this company offers laptops, offer printing machines, desktops, and so forth. So really, this is not a growth stock, really. But of course, in the year 2021, there has been a surge in sales because we were of course at COVID. So most people, most companies at a global level really needed to demand more of the products offered by Hewlett Packard, for example, the cameras for the video conferences and so forth. But of course, it is expected that in the following years, this growth in sales of Hewlett Packard could start decelerating for the foreseeable future. But anyway, in terms of the free cash flow divided by revenues, the company is producing an interesting portion, acceptable levels of portion of free cash flow divided by revenue, something between 5 and 9% here. And then another important point that truly has attracted Warren Buffett is that the company was able to deliver a predictable and stable free cash flow in the past here, which is extremely important to make a calculation of the DCF, because here in the calculation for the intrinsic value using the discounted cash flow methodology, we will need, of course, to make projections or predictions about the future free cash flow of this company. So it is important that this company in the past has been able to deliver a stable and predictable free cash flow, really. Now, in terms of the balance sheet here, the company is really solid because, well, if you divide the long-term debt, which represent most of the total debt of the company, if you divide it by the net income, you can notice here that all the total or the long-term debt can be paid in 1 year. In general, in the last 3 years, the company was able to pay back all the long-term debt using its net income in less than 2 years. And 2 years after the separation here, well, at least the company was able to pay back in less than 3 years, which is acceptable as well. In terms of the cash in balance sheet here, the company has 4.2 billion, which is enough to cover the short-term debt of the company and part of the long-term debt, really. So really, the company is holding cash to face unexpected events. So really, the important thing to understand is how the company is allocating its money to deliver value for the shareholders. So here, for example, we have that in terms of the dividends, well, the company was making dividend payments in a consistent way, and well, all these dividends represent something like 13%, 14% of the total free cash flow. So of course, the company is not using most of its free cash flow to make dividend payments, despite the fact that the dividend yield is acceptable. 2.14% of dividend yield is something acceptable here. But you should notice here that in terms of the repurchases, most of the free cash flow apparently is used to make repurchases. Look at this, how the repurchases divided by the free cash flow has evolved in the last years. I mean, the company was using more of its free cash flow to make repurchases, and this is something that apparently really attracts Warren Buffett, because if you combine this kind of shareholder orientation of the company, combined with a lower price over free cash flow, combined with a low price over earnings per share, and combined with the fact that the company is able to deliver a stable and predictable free cash flow without using so much debt, well, you have all the main characteristics that probably has attracted Warren Buffett here. Now, I just want to make a brief comment with respect to the equity here. You know that in the case of Hewlett Packard Inc., there has been a separation in the year 2016. So, since that year, the company was delivering negative equity in all the years. I need to make certain adjustments here, and I will explain to you later here. But first, we will need to go directly to the financial statements of the company here, and you can notice here that there has been a negative equity here. You know that when a company has a negative equity, it is because the company has lower assets than its total liabilities, which is something that could be a concern for many investors. But of course, the regular case, it is because the company is accumulating negative net profits over the years, and all these negative accumulated losses are included as part of the equity. And this is something that is really draining money in the balance sheet of the company. But this is not clearly the case because, as I shown to you, just looking into the metrics of this company, the company was able to deliver a positive and stable net profits over the years. So we need to discover what are the factors that are causing this negative equity in the case of Hewlett Packard Inc. So in order to discover what are the factors, we need to go directly to the consolidated statements of stockholders deficit here as part of the consolidated financial statements, and you will see how this is the equity, for example, of in the year 2018. This is the equity here of the year 2019. This is the equity here of the year 2020, and this is the equity here of the year 2021. You can see here that this is something that is coming from before the year 2018, most likely from the year of the separation from Hewlett Packard Enterprises. So we will go directly to the financial statements in the year 2015, the year 2016, really. Look at this. This is the equity here of the year 2014, 27.1, and this is the equity in the year 2015, 28.1 billion. This is the equity of the consolidated company in which, well, Hewlett Packard Enterprises and Hewlett Packard Inc. were part of the same company here. But then after the separation, you can see here the separation of Hewlett Packard Enterprises. This company uh, uh, has taken 32.5 billion as part of its own equity after the separation, and that of course created here a negative equity for Hewlett Packard Inc. You can notice here that this 32.5 billion needs to be subtracted from this 28.1 billion, and that was the first factor that explained the negative equity of Hewlett Packard Inc. Okay, so this is not something related to a negative accumulated losses. It is just because of accounting terms after the separation of these two companies. Then we will need to come back to our balance sheet from the last 2 years, in the year 2021 and 2020 here, and you can notice here that not only it was the separation, the only factor that was causing the negative equity here, it was the repurchases of common stock here. You can see here how big this number is, and you know that all the repurchases of common stock need to be included as part of the equity as negative, and this is because, well, this is part of the accounting rules, really. So really, this is something that has been repeated here because the company is making a strong repurchases of its common shares as part of its own policy here. So if you are starting with a really low equity, adding to the fact that you have a strong policy of making repurchases year by year, it is not a surprise that this company is delivering negative equity year by year. But this is something that should not be a concern, because as I explained to you, this company is delivering solid net profits and positive net profits over the years. So this is something that should not be a concern really. Now, In order to solve this problem, because this is because really with these repurchases we are reducing the equity in an artificial way. In order to eliminate that impact of this artificial impact here, you could turn the this number of the repurchases of common stock into from negative to a positive number here. In that way, you will eliminate this artificial impact of the repurchases of the common stock. So this is something that I just made here year by year. Look at this in the year 2021. We have minus 1.6 billion of negative equity. And you know that as part of this negative equity, there is a minus 6.2 billion of repurchases included. So in order to eliminate that minus 6.2 billion first, we will need to add 6.2 billion here, and then you will need to add again the 6.2 billion in order to turn from a negative into a positive one. So in that way, you will eliminate the impact of the repurchases as part of the equity here. So this is something that I just made in all these years, and then it was possible for me to calculate the return of equity in all these years, well, except for these 2 years after separation here. But you can notice here that how attractive the return of equity of this company really is. And as you can see, really, Warren Buffett did not have a concern of the negative equity of this company because, well, you can see here that the return of equity after making all these adjustments, really the return of equity is really attractive here. So these are the metrics of Hewlett Packard Enterprises here. You can notice here that I've taken all this data from the year 2015 to the year 2021 here from its financial statements here. So the first thing that I can show to you respect to the metrics of this company is the total debt used by this company. Look at this. In the year 2021 here, the company has used or has, well, it is holding something like 13.4 billion of total debt here. And the revenues of this company has been something like 27.7 billion here. And look at this. If you compare the total debt used by Hewlett Packard Inc., which is something like half of that total debt used by Hewlett Packard Enterprises, the company is able to generate 63.4 billion, which is more than double of the revenues produced by Hewlett Packard Enterprises. Now, this is something that, of course, can surprise you, but of course, that could be an indication that the Hewlett Packard Inc. is using in a better way its resources here. Now, in terms of, for example, of the capital expenditures here, you can notice here the capital expenditures of this company is only 582 million. Now, the company Hewlett Packard Enterprises is using more than 4 times that capital expenditures used by Hewlett Packard Inc. to only produce less than half in revenues than those produced by Hewlett Packard Inc. So really, we are talking about a company that is using more debt, more capital expenditures in the case of Hewlett Packard Enterprises here. Okay. Now, another interesting point is how this company is producing the net income and the free cash flow here. Look at this. The company in general, Hewlett Packard Enterprises has not been consistent here in its delivering of free cash flow here, despite the fact that the company really has been using so much debt here, something like double that the debt used by Hewlett Packard Inc. The company has not been able to deliver consistent and predictable free cash flow here. So, of course, I would have difficulties to make a proper calculation of the intrinsic value of this company using the DCF methodology here. Because honestly, I don't know how to make projections under these conditions, and I'm sure that Warren Buffett would have the same difficulty here. Well, the thing here is that not only this company is using or requires more capital expenditures, more total debt here, but also, well, the result of all of that, the company is producing just a poor return over equity here. Look at this. If you compare the return of equity of Hewlett Packard Inc. compared to that of Hewlett Packard Enterprises, the return of equity of this company has been more than 50% here. Whereas in the case of the return of equity of Hewlett Packard Enterprises has been most of the time just one digit of return here. Just in the last year of 2021, just 16%. But of course, we cannot make a proper projection for the future respect to this metric here. Now, another interesting metric here that caught my attention is the gross margin respect to the R&D expenses. I mean, this company, Hewlett Packard Inc., has been using has been using something like 12 and 14% of its gross margin for to be spent in R&D expenses. Whereas in the case of the Hewlett Packard Enterprises, the company has been using, well, in the last 2 years, something like 20, more than 20% of its gross margin for R&D expenses. But the thing here is that the company Hewlett Packard Enterprises has been using more money in R&D expenses just to produce 27 billion here, less than half of the total revenues produced by Hewlett Packard Inc. here. So really, we are talking about a company, Hewlett Packard Inc., that is able to use less R&D. I mean, to spend in less R&D expenses, to earn more gross margin, to to use only less than 25% of the total capital expenditures used by Hewlett Packard Enterprises. And of course, the most important thing I would say that the company is really able to produce a stable and predictable free cash flow here. So really, we are talking about Hewlett Packard Inc., which is a better company in quality. It is a way better company to make projections for the future and of course to calculate the intrinsic value of this company using the DCF methodology here. A company that is not producing consistent and stable free cash flow, of course, it is we don't know of course what would be the future policy of repurchases, because in that way the company will need to ask for other kind of financing to make the continuous repurchases for the future really. So this is something that is not sustainable here. And in the case, for example, of the dividends, well, you can notice here that in the last years, in average, the company was using something like 45% of the total earnings to make dividend payments. Whereas in the case of the Hewlett Packard Inc., the company was using 22.5% of its earnings to make dividend payments. So clearly, Hewlett Packard Inc. is using most of its money to make more repurchases. And given the fact that the company is delivering stable and predictable free cash flow and predictable earnings on stable earnings, the company is more sustainable to continuously applying that policy for the future. And of course, adding to the fact that making repurchases is a way more efficient policy than make dividend payments here because of the taxes really. So really, we this is a company, Hewlett Packard Enterprises, that needs to use more capital expenditures to remain competitive. And of course, this is a company that really needs all that capital to remain competitive in its own industry. But of course, if really Hewlett Packard Enterprises need all that money for those purposes, the company will have less money to make repurchases, to make dividend payments for the future. And this is something that, of course, will not add value for the shareholders in the long term. Now, this is my calculation of the intrinsic value here. I'm just assuming certain assumptions here. And the main purpose is, of course, to calculate intrinsic value and to determine what has been the margin of safety of Warren Buffett paying price of $36 per share. Now, the first assumption that I've just made is the outstanding number of shares according to the last number of shares in the year 2021 here. And I'm just assuming the free cash flow divided by revenues of 6%, which is really conservative because as you can see here, you can notice here that the free cash flow of revenues in the last 6 years, the company has something between 5.8% and 9.18%. So really, we are talking about a really pretty conservative generation of free cash flow divided by revenues. So really, this is the revenues, I mean, according to the last annual report of the company. And this is the sales growth that I'm estimating for this company here. According to the management, to the CEO of this company, he estimated that for the next years, the company could deliver something between 1, 2 or 3% of annual growth in sales. So I'm just being really conservative, only considering 1% of growth for the next years. Now, in order to estimate what could be the future revenues for the next years, I mean for this year, for the year 2023 and so on, I'm just considering here the 1% in each of these years in order to estimate the future revenues until the year 2026 here. Then, well, in order to or estimate the free cash flow, we will use this assumption here. We will multiply these revenues by this 6% in each of these revenues, future revenues here, and we will estimate a free cash flow estimated here. Now, this is now in order to estimate the perpetuity here. Well, I just will assume as well 1% here in the year 2027, and then, well, in order to calculate the present value of the free cash flow, because we are using the DCF here, we will just take this number, because you need to remember for the perpetuity there are there are more free cash flows here for the future beyond the year 2027 here. And in order to calculate the present value here, we will take the first number of this sequence here, and well, I'm taking here the discounted rate. I mean, the cost of opportunity that I'm taking here is that I'm considering here is 7%, according to this all these conditions of inflation rates and interest rate hikes and so forth. So I estimated I could get something like 7% annual returns in other opportunities. So this is my cost of opportunity, 7%, and I'm estimating here 1% here of growth in free cash flow year by year for all these years beyond the year 2027 here. You need to remember that this growth in free cash flow is really, really conservative, because in the last 6 years, you need to remember that in the last 6 years, this company had 5.8% of compound annual growth in free cash flow. So really, we are really being conservative here. So this is something really good, because we need to be conservative and put ourselves in the worst case scenario here. Now, in order to calculate, because this is the present value of all this sequence here, this is the present value here, but this is in the year 2026, and we are here in the year 2022. So we need to take again the present value of this number, and we will divide this one by one plus the 7%, the cost of opportunity that I'm considering here, at an exponent 5, because there is a 5 years here of difference. Okay, and then, well, we have the present value using the formula of the Excel here to calculate the present value of all these free cash flows here, and using, of course, the cost of opportunity that I just mentioned to you. Then, well, I will include the cash in the year of 2021 here, the cash in the balance sheet of the company, and the total debt here of the company in the year 2021 here. And to calculate the enterprise value here, we will add the perpetuity and the present value, and we will add the cash on the balance sheet, and we will subtract the total debt here. As a result, if we divide this enterprise value by the outstanding number of shares, we will get something like something like $50 per share here. Now, given the fact that Warren Buffett has paid something like $36 per share, the margin of safety is really pretty close to 40%, which is really, really good here. Really, really good margin of safety. You need to remember that we could make certain changes in our assumptions in order to see how our calculation of the intrinsic value could change. For example, in what happened if the free cash flow estimated could be something like 2% here, which could be really, really feasible for a company like Hewlett Packard here. And given the fact that in the past the company has delivered a growth compounding annual of 5.8%, well, it is totally possible, totally feasible that a company like Hewlett Packard could deliver something like 2% of compound annual growth in free cash flow here. And look at this, how the margin of safety increased to 61%. Okay, now what happened, for example, if we keep the 1% here and we change this proportion of free cash flow divided by revenues? For example, what happened if the company is totally feasible that the company is able to produce at least 7%? Look at this, how the margin of safety increased to 63% here. So really, we are being really conservative here. We need to put ourselves in the worst case scenario, because I don't like to estimate any other scenario. I'm only interested in the worst case scenario, because if the company is cheaper than my worst case, of course, that would be pretty interesting. And of course, when we are being conservative, really, we are adding the margin of safety in the different parts of the calculation of the intrinsic value here. So these are the competitors here of of Hewlett Packard in the different business units in which it participates here. For example, in the case of the PC systems, you know that we have Lenovo, Dell, Huawei, Acer, and so forth. And in the case of the printing, well, we have Canon, Lexmark, Xerox, Seiko, and so forth. But really, Hewlett Packard has developed a certain recognition in each of these business segments here, which is important to notice here because, well, in general, the company has developed a certain power to set higher prices for its products. Uh, I wouldn't say that there is a high difference between, for example, Hewlett Packard and Lenovo or Dell, because all of them, of course, all these company has is are offering better, high quality products, so and different services here. But in the case of Hewlett Packard, there are something subtle things that we need to recognize respect to the business model, respect to this long-term strategy here, and of course, how the management is allocating the money here. In the case, for example, of Hewlett Packard, really, I could notice that there is an orientation to reduce continuously the cost of the operations, and of course, there is a strong necessity to reward the shareholders for the long term. The company really doesn't need so much capital expenditures, and the company really doesn't need so much debt really to operate as usual. So it is important because all that money that is part of the maximizing of the free cash flow here is to make continuously repurchases, and this is something really interesting for the shareholders, and this is something that could have attracted a super investor like Warren Buffett. But in general, in the PC systems and in the printing, I would say that the company has adapted its strategy to take advantage of the current situation, which is that we are really in a hybrid scenario in which most of the workers, employees are sharing their time working at home and working at the office. And really, right now, the companies in general needs high quality video conference cameras, headsets, and among other different accessories that need to work well in order to not reduce the quality of the meetings in the office or in the companies in general using all these accessories. So really, and Hewlett Packard is taking advantage of that, adding to the fact that the company is really interested in making took in acquisition, which means that the company is more oriented to make acquisition of smaller companies that could be absorbed or that could be incorporated as part of the platform of products offered by Hewlett Packard. So this is something that the company really has made really, really good in the last years. And as part of the reasons why Warren Buffett has bought the shares of Hewlett Packard, really, and this is something really important because, well, you know that took-in acquisitions do not require so much money or to increase your financial leverage and so on, because the took-in acquisition involves the acquisition of a smaller company. So really, this is something really that could contribute to the sustainability of the generation of future free cash flow of the company for the long term. This is the case, for example, of the recent acquisitions of Hewlett Packard, like the case of Poly and HyperX. For example, in this case, in the Poly, the company wants to take advantage of the higher profitability of by offering peripherals for the PC. I mean, the different accessories that are surrounding the PCs, like the camera, the web cameras, the keyboards, and the mouses, and so forth. In the case of the HyperX, well, the company is taking advantage of the gaming sector, which is a sector that has an enormous growth prospects for the future, and this is something really interesting for the company here to take advantage, offering these peripherals here, which are of course highly profitable here. Now, in the case of the acquisition of Poly, you need to remember that, well, as I told you before, the video conference system, the audio and cameras are extremely important under this scenario of being a hybrid scenario right now here. And we don't know that, I mean, this kind of a scenario of hybrid scenario could last several years here. And now, something important to notice is that really the company has increased its power to set higher prices in the last years. And this is because there has been a shift toward more premium categories, more highly configurable products. And this is because the companies are demanding these kind of products, high quality products, under a scenario in which most of the colleagues and the workers and employees need to communicate themselves by video confident cameras, headsets, and so forth. So they are requiring high quality accessories here. And you need to remember that in the case of Hewlett Packard, 65% of the total revenues come from the companies rather than people. So this is something important because that increase, of course, the power of Hewlett Packard to set higher prices here. And adding to the fact that in general there is a higher demand than the supply in the PC and printing business, which is something important because that could be another force that could drive up the prices of the different products offered by Hewlett Packard here. And something important to notice is that in the printing business, in the last 3 years, the company has implemented a new strategy to make a shift or to make a transition toward a subscription model in the printing business. You know that the printing business represents something like 30% of the total revenues of the company, but of course, more than 50% of the earnings before interest, expense, and taxes. So this is the business that generates the highest profitability for Hewlett Packard. And right now in this transition model here, I mean, this is reinforcing this recurring revenues, is recurring free cash flow here, because it means that the customers will need to pay a fee for the services. I mean, the customers will have the right to receive upgraded printing machines and all the accessories involved in all the printing machines really. So this is something that is very convenient for the customers and very convenient for a company like Hewlett Packard, because that will enable the company to set higher fees as the company is offering a better and much more added value services as part of the services here. Right now, currently, well, we're talking about a 20, something between 20 and 30% of the total customers of Hewlett Packard are adopting the subscription model, and it is expected that this percentage will increase in the next years. And finally, something important to notice is Enrique Lores here. Enrique Lores has started his career in Hewlett Packard in the year 1989 as an intern after finishing his MBA. So he has worked in the company for more than 30 years, and it means that he was promoted to different departments in different countries. So he really knows really well when we detailed how the company could add value for the shareholder, how the company could add value for the different customers here. So probably, well, this is something unmatched because it is not easy to find CEOs that who started his career in the same company. So this is really an unmatched case, and probably most likely this is one of the most important factors that has attracted a super investor like Warren Buffett here. I would say, in my humble point of view, that Enrique Lores could be, I mean, 60% of the total decision of Warren Buffett to buy the shares of Hewlett Packard. And the thing is that really Enrique Lores has demonstrated to be shareholder oriented. He really is really focused and oriented to reduce the cost of the different operations involved in Hewlett Packard. And in that way, at the same time of increasing the net margins and setting higher prices, higher fees for the different services, he is maximizing the free cash flow generated by the company to make more repurchases and to reward more the shareholders here. And this is something really important, and truly I'm sure that Warren Buffett has focused in this company 40% for the company and 60% for Enrique Lores. And I'm sure that Enrique Lores will continuously make and really an outstanding job as a CEO of Hewlett Packard for delivering more value for the shareholders here. So as you have seen, really, Hewlett Packard has different characteristics that makes it suitable for a super investor like Warren Buffett here. We have noticed that the company doesn't need so much capital expenditures. The company doesn't need so much debt. The company has certain recognition, which gives it the power to set higher prices. And of course, the company, of course, has a certain power in the different markets in which the company has presence, expanding its operation through acquisitions or organically in different segments in different countries. So really, the company has a really interesting characteristics that probably has that those characteristics have attracted a super investor like Warren Buffett. And one of those characteristics is the management here. The manager Enrique Lores is a I mean, he thinks in terms of the shareholder, really. He not only has been promoted since the beginning, since 30 years ago when he has started his career in Hewlett Packard, and really he has been promoted to different departments, to different countries of this company. Really, he knows really pretty well this company here. So he really knows how to add value for the shareholders, how to add value for the clients, really. And this is the kind of things, of course, that attract a super investor like Warren Buffett. And of really interesting thing is how committed he is. I mean, Enrique Lores, how committed he is to reduce continuously the cost of the different operations in which the company is involved. That, of course, give the opportunity for the company to maximize its free cash flow year by year, and in that way I mean, the company will have more money to make more repurchases over the years in order to reward the shareholders. And the important thing is that all of this is aligned with the fact that the company likes to took in acquisitions. I mean, make acquisition of smaller companies that could be incorporated as part of the platform of the products offered by Hewlett Packard here. So really, that avoid the company to increase its financial leverage. So really, this is a company that is taking decisions that are sustainable for its future growth, for its future delivery of free cash flow. And this is the kind of things, of course, that attract a super investor like Warren Buffett here. So really, I hope that you really have enjoyed this video. Please put a like if you consider this is a video that is adding value to your investment knowledge. Consider to subscribe if you think that this channel could add value to your investment knowledge, or share all these kind of videos to a colleague, to a friend, because probably these kind of videos could be really helpful for them. So I will continuously delivering more and more information about different concepts, different companies, always since the value investing philosophy point of view. So I hope to see you in the next video. Peace.